Welcome to the Deep Dive. Today we're digging into PNB Housing Finance Ltd, PNB HFL. Specifically, their Q2 and first half results for fiscal 26, ending September 30th, 2025. We've got the earnings call transcript, the filings, plenty to work with. And our goal today is pretty straightforward. We want to quickly get you up to speed on their financial health, figure out what's really driving their growth, and look at how they're managing risk versus reward with their current strategy. It seems like a bit of a balancing act.
It really is. And what jumps out immediately, I think, is the sort of underlying tension here. The company put up some really strong numbers, despite, going through a pretty significant leadership change during the quarter, hitting those kinds of targets under that sort of pressure. Well, it says a lot about their team and the systems they have in place right now.
Okay, so let's get into those core numbers. Profitability first. It looks, well, pretty healthy, actually.
Yeah, very healthy.
Net profit after-tax PE for Q2 jumped, 23.8% year-on-year, came in at 582 crore rupees. It's a big number.
It is a solid number. Over $70 million just in Q2.
But profit's one thing. How efficiently are they making that money? The return on assets, ROA, that also improved, right?
Dramatically. It hit 2.73% for the quarter, annualized.
Okay, 2.73% ROA.
And that 2.73%, it's not just good. It's a strategic signal. It really puts them near the top of the pack for housing finance companies in India.
Right.
It shows they're deploying capital really effectively, much better than some peers who might be hovering below 2%. When you see that kind of ROA, it suggests a real focus on shareholder value.
And underpinning this profit momentum, the core lending engine. Net interest income, NII.
Also strong. Grew 14.4% year-on-year, reached 765 crore rupees. So the fundamental business is humming.
Okay, so income's up, efficiency's good. But, in lending, income growth often depends on how much you're paying for your own funds.
Yeah.
How did they manage their funding costs?
Yeah, that's where the margin story gets interesting. They actually managed to bring down their funding costs. The cost of borrowing, COB, it fell sequentially by 7 basis points in Q2, landed at 7.69%.
Okay, only 7 BPs, but still, going down is good.
Absolutely. And it was crucial. They said it was mainly down to, good negotiations with banks, plus the lagged effect of earlier repo rate cuts finally filtering through to cheaper institutional money.
And cheaper funding means better spreads.
Exactly. The spread, the difference between what they earn on loans and what they pay for funds, it widened slightly, up to 2.26% in Q2 from 2.23% in Q1. Now, that might sound small, just a few basis points, but when you combine even a slightly wider spread with growing loan volumes, it really juices the profitability. It's a multiplier effect.
Right, makes sense. Okay, the momentum looks good. But they're pushing into these newer, maybe riskier markets we'll talk about. Yep. So how's their safety cushion? The capital risk adequacy ratio, CRAR.
Still very strong, reported at 29.80%.
Wow, 29.8%. That's huge, isn't it? I mean, regulatory minimums are much lower. Is there a risk they're actually being too conservative here? Holding back capital that could fuel even faster growth?
That's a fair question, definitely. It is very high. But, management's view, especially given that leadership transition we talked about, is that this high CRR is actually a strategic asset right now.
Okay.
It provides confidence. Plus, as they push harder into affordable and emerging markets, which naturally carry a bit more risk, even with higher yields, having that nearly 30% buffer means they can absorb potential bumps.
Right.
It lets them fund that aggressive growth without having to suddenly scramble for more capital if things get choppy. Think of it like a safety net for their big strategic bet.
Speaking of that bet, the strategy pivot. It seems PNB HFL is basically all in on retail now.
Pretty much entirely, yeah. The retail loan book makes up 99.6% of their total loans now.
Wow.
It's a massive book, about 79,439 crore rupees, up 17% year-on-year. And the focus is clearly on the higher yielding stuff, not just easy volume.
So that 17% overall retail growth, where's the real engine?
It's almost entirely the affordable and emerging market segment, what they call ANEM, that combined segment. Its loan assets grew 34% year-on-year.
34%.
Yeah. And ANEM now accounts for 38% of their entire retail loan portfolio. So this isn't some side project anymore, it's core.
And within A&EM, you mentioned affordable housing specifically.
That's the real standout, just pure affordable housing loans. Their loan assets grew, get this, 121% year-on-year.
121%.
I know. Reaching 6,531 crore rupees.
Yeah.
And if you look at where the new loans came from in Q2, the disbursements, half of all retail disbursements came from these A&EM segments.
Okay, 121% growth is just wild. But that kind of speed must put enormous pressure on the ground, right, on underwriting risk management.
Hmm.
How are they actually handling that volume?
They're definitely building out the infrastructure. That seems key. Their distribution network is up to 356 branches or locations now. And crucially, 198 of those, almost 60%, are specifically dedicated just to the affordable segment. That high-touch model is needed for that market.
And they plan to keep expanding that footprint.
Yep. Management laid out plans to add another 40 to 50 branches each year. And the focus, they said, is clearly on Tier 2 and Tier 3 cities, capturing that demand where maybe the competition isn't quite as fierce as in the big metros.
So retail is booming. A&EM is the focus. What about the other side? The old corporate loan book. Are they just letting that wither away?
Pretty much, yeah. Intentionally winding it down. The corporate book shrank massively, 78.3% year on year. It's tiny now, just 332 crore rupees.
78% drop. How?
Well, apparently almost all of that reduction in Q2 came from foreclosing on just one single corporate loan.
Just one loan. Wow.
Yeah, it shows how focused they are on just clearing that legacy stuff off the books. They did say they might restart some corporate lending, but very cautiously. Gradual and slow was the phrase used. Highly selective cases, smaller ticket sizes, maybe up to 150, 200 crore rupees max. It sounds like they really want to avoid those big, lumpy corporate loans that can cause major headaches if they go sour.
Okay, so they're shifting aggressively into these potentially riskier, higher yield segments. Usually you'd expect maybe a temporary blip in asset quality, but their numbers actually improved.
Surprisingly, yes. The overall gross NPA non-performing assets actually fell, down to 1.04% from 1.24% a year ago, and net NPA is also quite low at 0.69%. Portfolio looks quite healthy overall.
But then there's that one number,
Yeah.
the one that probably made everyone do a double take on the earnings call, credit cost. It was negative 53 basis points for Q2.
Huh. Yeah. That definitely raised some eyebrows.
Negative credit cost. That sounds, well, almost impossible. How is that real? Is it just accounting noise, or does it actually mean something?
It sounds weird, I know, but it's real, though definitely temporary. It's not just an accounting trick. It reflects some specific, decisive actions they took. It came from two main things, largely one-offs. First, they had strong recoveries from loans they'd previously written off. About 59 crore rupees came back in.
Recoveries are always good.
Exactly. But the bigger piece was that they were able to release about 70 crore rupees in provisions they'd set aside for expected credit loss, or ECL.
Ah, okay. Why the release?
Because they successfully resolved and foreclosed on that big corporate loan we just talked about.
Got it. So the negative cost is basically a result of cleaning up that old corporate mess.
Precisely. It's temporary good news, but strategically important. It shows they're successfully tackling that legacy risk, freeing up capital and focus for the new retail strategy. And the recovery engine seems solid, too. They mentioned auctioning 178 repossessed properties in Q2 alone.
And there's still more potential recovery there.
Yeah, they said the remaining written-off pool is around 1,000 crore rupees, so you might see some more write-backs helping the bottom line in coming quarters, though probably not negative credit costs again.
Okay, that clears up the legacy part. But let's talk about the new risk, that booming affordable segment. The sources did mention a sequential uptick in delinquencies, right? The 30-plus days past due number went up a bit to 1.40% in Q2.
That's right. It did tick up sequentially.
Management called it seasoning. But, an increase is an increase. Is this the first warning sign that the push into higher risk profiles is starting to show cracks?
It's definitely something to watch closely. Management, though, seemed pretty clear that this was expected.
Expected.
Yeah, they attribute it to the portfolio maturing. Loans hitting that 12 to 24-month mark is often when you see payment patterns really settle, for better or worse. And critically, they stress that 1.40% is still well within industry benchmark.
That's the benchmark.
Apparently, the broader affordable housing industry average for 30-plus DPD is around 3.7%. So 1.40%, even with the uptick, still looks pretty controlled in comparison.
Okay, context is important there.
But, and this is the crucial point, the underlying risk is increasing. By design. That's the strategy. They're deliberately lending more to higher yielding, but inherently trickier customer profiles within affordable.
Cool.
We're talking about the self-employed segment. Think small shop owners, local service providers, people without formal salary slips or extensive documentation. That segment is now 43% of their affordable customer base.
43%. Wow.
And the purely informal segment, maybe even less documentation, is up to 30%. Now, this is great for financial inclusion, and it's where the higher yields are. But it absolutely requires super sharp, localized risk management and constant monitoring.
Because the data is less predictable.
Exactly. If they don't manage these specific segments extremely well as the book seasons further, those higher yields could quickly get eaten up by higher defaults down the road. It's the core challenge.
And we have to touch on, the sort of elephant in the room during the Q&A on the call, the leadership situation. They're still searching for a new CEO and MD, right?
Yeah.
Doesn't that kind of vacuum inevitably slow things down or create uncertainty?
Yeah, investors definitely asked about it. You could sense the anxiety, but management's response was quite firm.
What did they say?
Essentially, they assured everyone that the strategic plan, the roadmap out to March 2027, is completely intact and isn't changing. And they pointed to the results themselves as proof of the team's resilience.
Meaning the existing team just kept executing.
Pretty much. They highlighted that the operational focus was maintained, targets were met, basically business as usual despite the transition at the very top, which again speaks volumes about the structure beneath.
And technology must play a role in that resilience, especially managing that complex, affordable book.
Absolutely critical. They specifically mentioned deploying a new rule engine for their affordable business. They give it a name, Roshni.
Roshni. Okay.
Yeah, designed specifically to help automate and tighten up the underwriting for those more nuanced, informal customer profiles we just discussed.
Makes sense. More automation needed there.
Definitely. And they also reported achieving straight-through processing, SDP, for about 28% of their eligible salaried loan cases in Q2. That level of automation frees up resources and helps them scale the whole operation efficiently while keeping risk controls tight. It shows the tech upgrades needed for the A&EM pivot weren't shelved during the leadership search. #tag outro.
Okay, so let's try and wrap this deep dive up. Looking at PNB HFL's Q2 and first half. The big takeaway seems to be, well, kind of a two-part success story, right?
That's fair. Yeah.
On one hand, they successfully cleaned up a lot of that old corporate risk, which led to some unusually good numbers like that negative credit cost.
Right, the cleanup phase.
And on the other hand, they really hit the accelerator on their strategic shift into retail, specifically high-growth, high-yield segments like affordable housing. And so far, they seem to be managing the associated risks, judging by the overall profit and NPA numbers.
Exactly. Strong execution on both fronts. But, the thing that really sticks with me looking forward, it all comes down to that affordable portfolio. It's smart to target the self-employed and informal segments for yield and inclusion, but the entire long-term success of this strategy really hangs on one question. Can they keep that delinquency rate? Especially the serious delinquency, the 90-plus DPD, which is currently super low at 0.51% in affordable. Can they keep that low as this massive higher-risk book continues to mature over the next, say, 18-24 months?
Yeah.
How is that growing reliance on the informal economy going to truly stress test their risk models, their new tech like Roshni, and their on-the-ground collections over the next few quarters? That's the real test, and that's what you, as a listener, should probably keep the closest eye on.